Let me get the presentation right. Okay. As you said, I'm a former United Nations global expert in blockchain, cryptocurrencies, fintech, and regtech. I act as international board member on blockchain issues for several international companies like Massimo and organizations. I'm former university professor of fintech, and I work all around the world. What I want to get right now is the concept of CBDCs. And in fact, as we know, there are two different models outstanding. One is one-tier model, where we have digital money to be transferred directly from the central bank by the social security system to a single person. Of course, the social security system holds all the updated information of the persons. And this is something that is been happening because of COVID-19. The money transfers to be done in the, for instance, in the USA to the people who need them the most, the unemployed people, for instance, could be done directly via digital currency transfers from the government via the social security system to them. So we have direct payments via the blockchain, which allow the money to go fast to the people according to their information. And then we have the two-tier model, which is mostly adopted by central banks nowadays, at least in as a concept. And we have digital money to be transferred via intermediaries, which are mostly banks, to a single person. This is a model to be adopted in China. It's been proposed in the US and several other countries. Banks are not so much in favor of the introduction of a digital currency because they would suffer the most if the one-tier system is adopted. But the companies that are worse off because of the introduction of a digital currency will be the likes of Visa, MasterCard, and we're going to see why. The processing of transactions in the future will not need a credit card, but only digital currency wallets. Now, we are talking about the evolution of CBDCs. Now we see where we stand now and where we were in the past. There was a recent survey in January 2021 of the BIS about CBDCs. And in this survey, in the CBDC space, central banks are all progressing from conceptual research to practical experimentation. Most of the banks, central banks, have no plans to issue CBDCs in the foreseeable future. However, central banks representing at least 20% of the world's population are likely to launch retail CBDCs the next 3 years. So this is a statement which looks a bit contradictory, but in fact it is not, because all central banks are looking at that and most will progress into that direction. What are the motivations for issuing general purpose CBDCs? First of all, payment related motivations, such as domestic payments efficiency and payment safety, financial inclusion, which is a big issue for less developed countries. And in fact, central banks located in emerging markets report stronger motivations for issuing CBDCs than central banks located in advanced economies, just because of financial inclusion. And then we see that CBDCs are already there. For instance, in Bahamas, the $100 was introduced very recently to help facilitate financial inclusion in this nation of 390,000 people spread across 30 inhabitant islands, many of them remote. That is why financial inclusion is a big step, a big issue for CBDCs. And then also there is the issue of financial stability and the control of monetary policy, and public, and also the fact that there's a public alternative in the case of widespread adoption of private digital currencies denominated in major foreign currencies like Libra. Now, in the past, as we said, we are seeing the evolution. Just 1 year ago, October 9th, 2020, Bank of Canada, Bank of England, Bank of Japan, ECB, and some other central banks issued, together with the BIS, the main principles of a report stating 3 main principles about CBDCs. And these principles have stayed the same. So we see that, in fact, the evolution of CBDCs, the main pillars are the same, but we are moving more and more towards that. The principles were, first of all, central banks should not compromise monetary or financial stability by issuing CBDCs. Second, CBDCs need to coexist with and complement existing form of money. And also, features should promote innovation and efficiency. These pillars are always the same, 1 year ago and now. The report outlined also fundamental principles and core features of CBDCs, but didn't give an opinion on whether to issue. As we said, now the 20% of central banks are more and more prone to issue CBDCs. Central banks are continuing to investigating CBDC feasibility without committing to issuance, and the possible adverse impact of CBDCs on bank funding and financial intermediation, as we're going to see, including the destabilizing run into central bank money, has been a concern of central banks. And why is that? We're going to see it as we take a concrete example. For instance, the DCEP. DCEP is the central bank digital currency, which is being tested right now in China. The main features of DCEP are, first of all, is exactly the same as paper money, but it is just a digital form. Also, it is to be transferred between users even without an account or without a mobile or internet network. But if users have a mobile phone and the user's mobile phone has a wallet, the digital currency can be transferred to another person by placing the 2 phones in physical contact, technology called NFC. Also, one interesting thing is that to introduce CBDCs, we do not need only blockchain technology, because this, in fact, the current technology would not be able to handle transaction volumes in China. This is an important issue. Then we see the main proposals, as we said, also in US, there is the issue of CBDCs. And in fact, there is the Digital Dollar Project, a partnership between the Digital Dollar Foundation and Accenture to advance the exploration of a digital dollar. We're talking here of exploration. No, it's not something concretely applied like in China. The main features are similar, though. It's first of all a 2-tier model where a digital dollar will be a tokenized form of US dollar. Also, a digital dollar will operate alongside existing fiat currency and commercial bank money. And a digital dollar will be distributed through the existing 2-tiered architecture of commercial banks and regulated intermediaries. But the digital dollar will not impact the Federal Reserve's ability to affect monetary policy and control inflation. Now, what is the impact of CBDC? The impact is, in fact, is positive for consumers. Why? Because if we think about, in the current interest rate environment, the only advantage of having a bank account is that it enables digital payments because there is no interest remuneration. But the potential impact is crowding out of bank deposits. Why? Because there are many costs related to having a bank account, especially for every single transaction down, lower security because of breaches from hackers, and fees to be paid for electronic transactions using credit cards. So the use of digital currency eliminates the need of a bank account. All you need is a digital wallet, which allows you to hold digital money and makes you pay the bills using the mobile phone without using the credit card. There are no fees to be paid to credit card processing companies, Visa, MasterCard, even SWIFT. No fees to be paid to banks for bank money transfers or for holding a bank account. So this is, in few words, the presentation. And if there are some other questions, I would be happy to answer them.